The trick is not to learn to trust your gut feelings, but rather to discipline yourself to ignore them. Stand by your stocks as long as the fundamental story of the company hasn't changed. Peter Lynch. Peter Lynch is widely regarded as one of the best investors of all time. At Fidelity, Lynch oversaw the storied Magellan Fund. During his tenure as manager, the fund generated an annualized return of 29.2%, or more than twice as much as the S&P 500. But how does an amateur investor turn into the level of Peter Lynch? Keep watching to find out. One Up on Wall Street is a book authored by Peter Lynch. In his book, Peter Lynch challenges conventional wisdom about what it takes to be a successful investor, arguing that even novices can outperform Wall Street pros by relying on reason and common sense. You should only invest in businesses that you have researched thoroughly. He felt that certain people should take advantage of their favorable circumstances by investing in stocks the right way and on the right foundation. Let's talk more about the habits one should develop to make sound decisions. Capitalize on your expertise. Listening to the radio, reading the newspaper, or watching television all provide opportunities for direct analysis. We can be on the lookout for promising investment opportunities while commuting, sightseeing, or otherwise occupying our time. 2/3 of the United States' economic output comes from the purchase made by individuals. If something interests you as a customer, it should also pique your interest as an investor, because that's who most of the stock market is geared towards serving: you. Getting to know the fundamentals of a company is a great first step in determining whether or not it has the potential to be profitable and successful. Long-term success is more likely for businesses that produce items that many people want to buy. You should also evaluate the services offered by a company to see if they will still be in demand in the future. The same level of research and comprehension is required for picking winning stocks, a point made by many of the industry's greatest investors. For decades, Warren Buffett has yelled it from the rooftops, while Peter Lynch, the renowned ex-manager of the Fidelity Magellan Fund, warned, "Never invest in any idea you can't illustrate with a crayon." The future performance of stock or its viability as a winner cannot be determined with any degree of certainty. However, you can increase your chances of long-term portfolio success by familiarizing yourself with what to look for when purchasing stocks. It is easier to ride out market fluctuations and generate long-term gains if you know how to identify promising stocks. Understand the competitive environment. A common illustration of this phenomenon is a restaurant that thrives mostly due to its location. Because of this, customers will continue to patronize the establishment even if the cuisine is subpar. But if a rival restaurant sets up in the area, the existing one will have to fight for customers by raising the quality of its food and/or reduce prices. This is great for both the business and their customers, because competition drives organizations to innovate and improve. The customers ultimately benefit from this through a better customer experience. Do proper research. This can all be said for any investment processes, but it's still one of the most important factors that led to Peter Lynch's success. Simply put, a stock is a fractional share of ownership in a company. Would you back a tiny local company without first studying its financials to learn about its income, expenses, seasonality, possibilities, risks, and competitive advantages? As a prudent investor, you should consider factors beyond those immediately apparent. There is easy access to information about potentially lucrative investment opportunities out there, but everyone else is looking at the same information. If a corporation has a stock that does well on the stock market, for instance, that fact will be obvious to anyone who looks. However, if you want to gain an advantage over your fellow investors and beat the market over time, you should look farther into a business to discover the details of what makes it tick, like what are its e-commerce platforms or retail stores like. Check the supplier network and other businesses it has relationships with that could contribute to the company's long-term success. Do your homework. It is not simple to grasp how the stock market works. So instead of attempting to decipher this immensely complicated machine, you should begin by becoming very familiar with the product that you intend to invest in. Carry out the necessary research, and as was mentioned before, invest in something that is familiar to you, something you know, something you trust. Keep watching to find out more about the secrets of this Wall Street titan. Peter Lynch was himself a type of investor known as a story investor. Before making an investment, He did extensive research on the company and constructed a narrative or story around the growth route it would take. In order to construct said narrative, Lynch would ask questions such as, what is the firm doing now? What are the company goals? What is it doing to attain these goals? And so on. After doing an analysis of the company using a variety of narratives, it can be categorized into one of several groups. Categories such as sluggish growth or rapid growth or cyclical and many more can be constructed. This leads to the next point. Refine your selection process. Lynch's bottom-up strategy necessitates the selection of stocks one at a time and conducting detailed research into each company. Unfortunately, there is no magic algorithm or shortcut. Instead, Lynch recommends that investors maintain a heightened awareness for opportunities based on their own experiences, such as those gained while operating their own company or trade, or as customers of various businesses. The next thing to do is become properly acquainted with the organization, since this will allow you to formulate appropriate expectations regarding the future. Lynch, on the other hand, is not convinced that investors are able to accurately forecast actual growth rates, and he is wary of the earning predictions provided by experts. Instead, he recommends looking at the plans that the company has for increasing its profits, as well as how well those goals are currently being carried out. Lynch identifies the following 5 methods by which a firm can boost its profits. It is also possible to increase pricing, expand into new markets, sell more in existing areas, or either rehabilitate, close, or sell a business that is not profitable. The narrative of the company is its strategy to increase earnings and its capacity to accomplish that goal. The more knowledgeable you are with the company or the industry, the more of an advantage you have when evaluating the company's plan, abilities, and any potential problems. Lynch's strategy is based primarily on analysis. When analyzing a company, he looks for a thorough grasp of its operations and future possibilities, competitive advantages, as well as an assessment of any obstacles that could derail the company's intended narrative. If the story has a good conclusion, but the stock was bought at a too high a price, the investor still loses money. He wants to find out what it's really worth. Buy stocks for the long run. Most of the time, it's better to buy equities for the long haul than to try to time the market and choose winners in the near term. How does one locate good companies? Focus on the value. Find equities that are undervalued relative to their potential future gains based on objective metrics. Learn how to identify firms with sustainable growth. Stocks that have a long history of increasing their dividend payments are a smart place to look. Or consider the company's long-term profitability. A company's chances of survival and success increase when it has a track record of wise decision-making and responsiveness to market shifts. Buying and selling too frequently can lower your rewards. In addition, another great way to lose money is by trying to time the market. This is a strategy that can't be relied upon for long-term growth of your wealth. Instead, you should think of a plan that will allow you to put your money into companies that will still be trading and paying dividends in the years to come. Mistakes will happen. You are not a lousy investor just because you have experienced a loss. It's inevitable whether you're putting your money into an individual stock, a mutual fund with a manager, or an index fund. Mistakes do eventually happen. You may have bought into the wrong company or bought at the top of a cycle. This is a part of the life of an investor. Accept this, learn from these mistakes, and move on undeterred. We have discussed how Peter Lynch's advice may help anyone achieve success, including buying just what you fully comprehend and conducting in-depth study. But here is a little perspective. It is imperative that you do not overlook the necessity of pausing to take pleasure in each stage of the process. Peter Lynch was blessed with enough wealth to be able to retire and provide for his family, in addition to contributing to charitable causes and educational institutions. Never lose sight of your ambitions and goals. Enjoy the journey and believe in yourself. We hope you enjoyed the video. Do you have any tips that you have heard from other investor legends? Feel free to share them in the comments down below. If you want to learn more about becoming rich, click the videos on the screen. We hope you have a nice day and thank you.